The big question on everyone's minds as we head into 2026, what should I be invested in? Crypto or stocks, and what is going to outperform in the year ahead? Well, in today's video, I'm here to break that down for you in detail, provide the bullish and bearish outlook of both asset classes and the exact specific factors that you need to be aware of to make decisions in terms of allocating your capital between both markets. And yes, guys, I know it's been a while since the last time we did one of these videos. End of year is always crazy in my world, setting up the game plan for the year ahead. And this one came with a particular twist this year because I ran into a problem at the end of last year. I realized that crypto markets weren't the place to have the majority of my net worth anymore. Right? I'd always been diversified between crypto and equities, but my equity exposure was all centered around crypto. So when I did my big de-risk in October, when the market signs started to show that a Q4 rally was no longer going to be underway, I branched out into stocks. And you can see that video on this channel, what I talked about specifically and why. And that took up a ton of my time, end of year, reorganizing, reconfiguring the strategy for myself and ultimately members of Bull Market Blueprint. But the good news is I've worked through the holidays and I've figured out an amazing strategy. I figured out an amazing game plan for the year ahead. And I'm going to share a quick snippet of all that with you here on YouTube today. So first of all, let's jump into the crypto outlook for 2026. Now let's talk about 3 bull cases that I see for crypto specifically that could build a really strong bull market for crypto holders, for crypto enthusiasts, and ultimately allow Bitcoin to strengthen as we go throughout 2026. Number one bull case I could see forming for the crypto outlook is that monetary policy becomes accommodative enough for liquidity to expand. Now, this is liquidity in the US and liquidity globally is what we would need to see expanding in order for there to be a massive crypto bull market or continuation of the bull market that we have just gone through or potentially are still already in. Now, we've seen the Fed end quantitative tightening at the beginning of December and actually come out and announce at the December FOMC meeting the launch of something they're calling RMPs or reserve management purchases. And these inject about $40 billion in short-term treasury purchases on a monthly ongoing basis between now and about April, right? So they're wanting to continue this going for the rest of presumably Jerome Powell's tenure at the Fed. And this ultimately, at this amount or at a greater amount, could improve liquidity conditions across the board. Now, we did face a lot of funding market stress in the end of Q4 last year, and ultimately that's what provided so much chop in terms of conditions for the crypto markets, for the equity markets, etc. But if we have these expectations of weaker monetary policy, more insurance rate cuts, right? Not rate cuts into a recession, but rate cuts into a growing economy and growing markets. We have a weaker dollar ultimately as a result of that, and we have rising global liquidity, which is the factor that sort of sums all of these parts together. Well, historically, that would coincide with stronger performance in risk assets, right? And if you look at crypto specifically, crypto is the farthest right on the risk curve. And I've outlined that here for you guys to understand. These would be bonds on this side, and this would be crypto, small caps, and ultra high risk investments on the right-hand side of the risk curve. And stocks, depending on what sector, would sit somewhere along the middle and lean left or lean right, depending on their asset class. Now, that's number one. Number two, macroeconomic concerns right now. Okay, so many people are concerned about the amount of public debt, right? The decline of the US dollar in 2025, losing 10% of its value. So there's all of this inflationary pressure. There's debasement of currency concerns fluctuating around the world, or the fluctuation of currency, I should say, and debasement ultimately being a main concern in people's sort of macroeconomic view. And this may allow more institutional investors to adopt a crypto. And when I say crypto, I mean mainly Bitcoin and large cap focused strategy towards trying to outrun inflation and monetary debasement through these hedges. Now, historically, what we've always seen is that crypto cycles have been mainly retail driven. They have not been driven by institutional investors up until this most recent cycle. But if we have a continued wave of institutional interest and a retail interest wave, we could see an amazing market in 2026. We also have global M2 money supply at record levels. We have sovereign debt concerns that are starting to mount. So if Bitcoin can cement its role as a hedge against fiat currency debasement, then potentially it could gain a higher degree of recognition as an asset and capture more allocations ultimately. So we may see Bitcoin's price trajectory in 2026 reflect macroeconomic fundamentals more than ever, but ultimately it must get past the retail investment audience. And the question has to be answered, is Bitcoin a safe haven, right? The problem with Bitcoin currently is that it's the most liquid global asset that trades 24/7. So anytime there's any pressure to de-risk or to come up with liquidity, Bitcoin is the easiest asset for global investors to sell and become liquid from. Now, the third case, and I've ordered these from where I see them being most important and most probable in terms of what will actually push a bull market forward in each of these examples, to least important, but also still likely to play out, is the regulatory clarity and pro-crypto policy frameworks that are in order right now. So we've seen Genius Act passed in July of 2025. That was our first real look at crypto regulation in the US finally coming to light. And we also had the CFTC's Digital Asset Collateral No Action Letter, which allowed Futures Commission merchants to accept Bitcoin and Ethereum as margin collateral. So some very big developments happening in the world of crypto regulation last year in the US. And there's more on the way that's expected to pass sometime mid this year. And if that happens, could further integrate public blockchains or crypto with traditional financial rails and financial systems, more so than what we've already seen developed in 2024 and 2025. So this could allow a lot of institutional money that has uncertainty around crypto because of regulatory issues or not wanting to break the rules or sort of cross any regulatory gray lines, to allowing them to say, hey, well, now that we understand the rules, then therefore we can invest more of our capital towards these markets where we identify opportunities. So that is the three factors that I could see contributing to a crypto bull run in 2026 in order of importance. Now let's talk about the bear case, because this is ultimately very important as well, because you have to have a plan for all outcomes. You can't just plan for one scenario, right? You can't just plan for one potential. You have to have a plan for all outcomes. And in my view, the bear case is that we may see tighter than expected monetary policy and the impact of a declining global liquidity rate of change and absolute value. So there's many expectations for rate cuts, right? We did see in the December meeting that the dot plot signaled only one more rate cut for the Fed in 2026. And that is a relatively hawkish stance from the perspective of the dot plot. Now, the $40 billion RMPs by no means are a hawkish signal, but if we don't get any more rate cuts, I think markets are going to be asking for more liquidity in the form of rate cuts. Now, we also have this combination, right? The slower or non-existent cutting pace. Remember, in 2025, we only had rate cuts kick in September. The first 9 months of the year were on pause. So if we see a slow or non-existent cutting pace and a very cautious messaging tone from the Fed, this will ultimately pressure crypto markets in a big way. And we have global liquidity, right? End of cycle or EOC concerns starting to accelerate. And this could potentially allow capital to flight out of the crypto markets if financial conditions tighten up, right? The question is, will RMPs be enough to reverse the end of year liquidity downturn that we had in the US and globally last year, which allowed markets to sort of stutter in neutral for the fourth quarter of the year? If we zoom in on this global liquidity cycle index, this comes from Michael Howell of Global Liquidity Indexes, you can see that we've already started to have this rollover in global liquidity. And these cycles, right, these 65-month sine wave cycles pretty much align very closely with how global liquidity tends to ebb and flow and how asset markets perform during the ebbs and the flows of these global liquidity cycles. So if we have a downturn like we did at the beginning of 2022 and the end of 2021, well, you may be looking at a repeat of 2022 for 2026 based off of the model of global liquidity. Not enough liquidity to support markets. Obviously, liquidity or crypto itself is the most liquidity sensitive asset class that you can be invested in. Bitcoin is always responding to amounts of global liquidity in the system. Therefore, you may want to be cautious if the global liquidity cycle continues to roll over, right? It is already rolled over to some degree from a rate of change perspective. If it rolls over further, it's not going to be a very fun year for crypto, most likely. Then a secondary concern I could see would be digital asset treasury forced selling pressure, or DATs. So we've all heard of DATs, these digital asset treasury companies, and they've been increasing their holdings of crypto over the past couple of years, mainly in 2025, but they're now facing some severe stress, right? We have over a dozen crypto DAT firms now trading below their net asset value values. And this likely eliminates their previous ability to issue shares and potentially force liquidations as a result if prices take another dive lower than where they already have gone to. Now, this previously was a reflexive mechanism, right? It allowed companies to buy Bitcoin and altcoins at premiums, and it's reversed. So it's created this negative feedback loop where lower prices lead to the compression of that premium, the compression of MNAV, and reduced buying capacity. So if we see these MNAVs or M net asset values continuing to fall, then you may see DATs become compelled to sell their holdings. Now, we won't really know what happened in Q4 until we get reports that come out in Q1, but if it's already a waning liquidity environment and you throw on digital asset selling on top of that, or digital asset treasury selling on top of that, it could very much affect the volatility to the downside in an already weakening liquidity environment. So we have to be careful and understand that this is not an unlikely scenario. If we continue to see prices go lower, it will put more pressure on DATs. Now, the third and final argument for a bear market in 2026 is market cycle structure vulnerability. And you may ask, well, where does this come from? This sounds rather complicated. And it's really simple. The traditional 4-year cycle theory itself does suggest that 2026 should be a bear market year. Okay. 2022, bear market year. 2018, bear market year. They all followed their post-halving year all-time highs, euphoria, and into the bear market subsequently the year after. Now, historical patterns suggest that the market peaks in that time frame, and then we have a prolonged downturn, right? Now, this could be a self-fulfilling prophecy. This could be the nature of how Bitcoin used to operate in a pre-institutional era. But it is interesting to note that while the institutions are now involved, they're also adopting frameworks that could suggest they potentially believe in this scenario being true. We've seen JP Morgan Chase introducing structured notes that are linked to BlackRock's IBIT, so their ETF, that explicitly match Bitcoin's 4-year halving cycle, anticipating a downturn in 2026 before the next halving-driven bull market potentially peaks in 2028. So the actual product design of these structured notes reflects their beliefs that historical patterns could remain true in the world of Bitcoin and crypto investing. Now, one thing I wanted to point out related to the 4-year cycle, whether it's broken or not, one thing that we've always seen true is that Bitcoin, when it makes an all-time high, finds its way back to the 200-week moving average before bottoming and subsequently running to new all-time highs in the next bull market. We saw it happen each and every time. Will it happen again? Right? Right now, the 200-week moving average is all the way down at 57.5K and ever increasing towards 60 and so on. Do we have to revisit those levels in order for the market to officially find its bottom before getting there? One thing we also have to note is that if you zoom in, you're starting to see that 20-week moving average cross the 50-week. The last time we saw that happen was March of 2022, little bear market rally, and then we started to really move towards the lows here. So something to be cognizant of for sure is the 4-year cycle. Not that it has to play out again or it ever has to play out anymore, but it's something that we need to be aware of, and it could be a self-fulfilling prophecy. So there's 3 arguments I could see for crypto underperforming in 2026. That was followed by 3 arguments for crypto outperforming in 2026. Now, we talked about at the beginning of this video, what's going to outperform, crypto or stocks? What's going to be the better option to be invested in the new year? So let's look at the stock market outlook, starting with the bull case for stocks. Well, it's actually the same bull case for crypto. Everything boils down to liquidity and monetary policy. This is the bull case where we see monetary policy becoming accommodative enough for a liquidity expansion. Same concept as crypto. We're seeing these RMPs come in. We're seeing rate cuts that have happened already and are expected to continue, although the dot plot tells us we're only going to get one. So if liquidity conditions improve, historically what we should see is that these Fed easing cycles outside of recessions have provided very strong tailwinds for equity markets. This is usually where you see the S&P 500 generating positive returns 90% of the time. There is something to be aware of here. If liquidity is positive, if rate cuts are responded to well by the market and the market continues to grow, we should have a pretty strong year in the equity market if liquidity is strong enough for it, right? We can see lower borrowing costs actually support higher stock valuations. They help improve corporate profitability. Ultimately, that's what shareholders are buying. And if you have reduced financing costs from lower interest rates, that benefits all sectors of the stock market. So this is something to be taken seriously. The question is, like I said over here in crypto world, are RMPs enough to save the liquidity picture in the US that has gotten rather bleak in Q4 of last year? And it's too early into this year to really tell the stance of US liquidity at the moment. Give it another couple of weeks, and it'll be a much more clear picture. Now, second to that, what makes up the bull case for 2026 for stocks is fiscal stimulus from the one big beautiful bill. or the OBBBA. Now, the One Big Beautiful Bill actually provides a very substantial degree of fiscal stimulus to the markets. This is expected to boost growth in 2026 because we're seeing a massive amount of business and consumer tax cuts. It could be up to $285 billion in tax cuts that stays in the system. Right? This is liquidity that stays in the financial system, that stays spendable by people and businesses. And we also see consumer benefits, including $100 to $150 billion increased tax refund arriving in February to March. So again, that's also liquidity positive because it's taking money out of the TGA and putting it into the real economy for people to spend and for people to invest. That's an average tax refund increase of 44%. So that's quite significant. Then on the business side, you have incentives for capital expenditure to be written off, right? 100% expensing for capital equipment purchases, immediate expensing for R&D costs, research and development, and more generous corporate interest deductions, immediate expensing for manufacturing facility construction, which is all of this is retroactive to 2025, by the way. So this could be huge for markets this year. And if you look at what the analysts are saying on Wall Street, specifically from Goldman Sachs, they estimate this fiscal boost could add a meaningful amount of GDP growth in 2026, particularly in the first half alone. So there's a lot of fiscal stimulus here, right? And if you pair that with a lot of monetary stimulus and lighter monetary policy, this could be the double whammy combo that sends markets way higher in 2026. Now, that was a terrible analogy for saying why they should send in 2026, but it really is, right? It's the 1-2 knockout punch combo for markets in 2026 is if we see monetary policy supportive and we see fiscal stimulus accommodative and expanding and people take advantage of this and businesses grow as a result, there's a very strong bull case to be made here for equities. This will translate over to crypto. Finally, we'll get to what is going to outperform ultimately towards the end of the video. Now, strong earnings would be the third point that I'd like to make for the stock market this year. We have corporate earnings that are projected to continue their very robust current trajectory in 2026. Consensus estimates are pointing that the S&P 500 earnings per share, or EPS, should grow 12 to 15%, which is way above the historical average of less than 10%. And that'd be a third year of consecutive double-digit earnings gains for S&P 500 basket companies. Then we also have the tech sector, which is projected to grow 19.9% earnings-wise, while all 16 sectors in the S&P 500 are expected to post positive earnings growth for the first time since 2018. So many Wall Street analysts here anticipating about 12% EPS growth or earnings per share growth in 2026 and 10% in 2027, and profit margins remaining elevated as a result of that. Now, one thing I want to note about that, if we look at EPS growth, right, usually what happens is that we have a massive earnings per share bump in the second year of the presidency. And that's the year that we're going into right now in Donald Trump's second term. So with that being said, let's jump into the bear case because these are actually tied together. This could be a positive. This could also be a negative for the markets. And I'll explain to you how that works, even though it doesn't really seem like it should in a moment. Let's jump into the bear case. The bear case for the equity market, and of course, crypto is intertwined and correlated here, is that we have, again, tighter than expected monetary policy and global liquidity impact. So do you guys see how what I've mapped out here is similar on both sides, right? Monetary policy is the most important bull case for crypto. It's the most important bull case for equities. It's also the most important bear case for crypto, most important bear case for equities, because if the liquidity environment is not right, we will not have ripe market conditions for a bull market in both asset classes. So let's dive into the bear case and talk about how liquidity itself could affect us to the downside. Well, we've talked about it in this video. There's expectations for multiple rate cuts this year, right? We've seen the Fed's dot plot. They're not talking about multiple rate cuts. They're only signaling one. So if we have a relatively hawkish Fed stance, it's going to create difficulty for risk assets to really flourish properly if inflation remains sticky and the Fed decides they're not ultimately going to cut rates more or even at all. Right? So the combination of slower or non-existent cutting and a very cautious messaging stance from the Fed could really continue to hurt this trend that we're seeing in global liquidity right now, where it's rolling over, right? These end of cycle concerns could really accelerate if we don't see RMPs being enough to boost Fed net liquidity and ultimately boost global liquidity back up, which is what we want to see to have a very healthy run in 2026 without a lot of hiccups in the markets. Okay. Now, number two is that elevated valuations leave very little error for margin currently, right? We have the S&P 500, which is currently trading at 22 to 26 times earnings and 22 to 23 times forward earnings. This is well above historical averages. You'll see many people calling this out across markets and saying markets are at the top because of this. And we see the Shiller CAEP ratio standing near 39, which is approaching a level that historically preceded very significant market downturns. We're talking 2008, we're talking 2000, blah, 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 blah. You get it. The point is markets are extremely highly valued at the moment, right? Now, companies are very profitable and demanding a higher valuation as a result, but this doesn't leave very much room for error because markets are now essentially pricing in perfection for the year ahead and double-digit earnings growth right off the bat, which leaves stocks very vulnerable to any disappointments in growth or margin compression. Now, this video is coming out on Tuesday, January 13th. Today is the first day of corporate earnings being reported in some sectors of the stock market. This is exactly what investors are going to start to consider to factor into their analysis when they're looking at earnings and going, are these companies that we're invested in truly worth the numbers that they're posting earnings-wise and ultimately their valuations, so on and so forth. The reason why we care about this is because when valuations are this elevated, even modest shortfalls like we could see happen in this earnings season can trigger very sharp price declines rather than having any sort of degree of valuation cushion, which a lot of these assets don't currently have, or these stocks don't have, I should say. The S&P 500 is trading 18% above its 3-year moving average. This is a level that's historically correlated with increased volatility, much more frequent corrections, and larger drawdowns within those corrections. All right, so we have to understand that there's no valuation cushion that's existing below stocks during these periods where we're having above average multiples. And if we look at global liquidity, right, one of the biggest things that you want to note global liquidity wise is that we're seeing this exact trend start to play out. Global liquidity is rolling over, right? Earnings per share growth expected to be high. This is what happens historically, 1970 to 2024. You have that massive earnings per share growth in the second year of the presidency, but usually we see the S&P 500 gain the least in the second year of the presidency, right? Why does this happen? Valuation compression, right? This is the core concept that you'll need to study after this video is why do stocks trade worse in the second year of the presidential term? A couple of things I wanted to go over from our most recent live call in BNB I wanted to share with you guys because we did talk about this in our outlook for the year ahead at the beginning of this one. We talked about a view from Michael Howell, founder of Global Liquidity as a concept, talking about how historically presidential cycle data shows the second year often delivers strong earnings but weak equity returns due to valuation compression. All right, we have weaker global liquidity, we have commodities outperforming, we have inflation hedges that are not performing very well at the moment in the world of crypto, but very, very much performing well in the world of precious metals. So there's a mixed bag, right, in terms of most people's view on the market based off of what's currently performing, because it's not like there's one set of sectors that are clearly moving forward like they were all of 2025 or for 9 months of 2025, let's say. So valuation compression is something to be considered very, very closely. And then ultimately, we're seeing record low cash allocations across the board for equity investors. And this is concerning because if there's no cash to continue buying the markets and there's no cash to sit there and fund buying the dips, ultimately, what do people have the option to do? The only real option they have to do is to hold or to de-risk. And if we see another downturn like we saw in early 2025, de-risking will occur and people will capitulate into the lows and we'll see a pretty nasty sell-off potentially. Now, the data behind this is that Bank of America's December 2025 Global Fund Manager Survey revealed cash levels collapsed to just 3.3%. Now, this is the lowest level on record, right? The lowest level on record and down from an even previous reading that was lowest on record at 3.7 in November. So this has triggered a proprietary contrarian sell signal from Bank of America, which historically activates when professional investors are holding less than 4% cash, right? 96% allocated, 4% cash. Does that sound like a risk to you? Sounds like a risk to me. Also, we're seeing their bull and bear indicators simultaneously surging to 8.9 out of 10. So 8.9 out of 10 investors are very bullish and optimistic about the market. So there's high degrees of optimism in the market right now. Not necessarily euphoria, but optimism, borderline euphoria depending on the asset class. And we're also seeing that same Bank of America survey showing fund managers are dramatically overweight equities and commodities. so equities and gold, while underweight cash at historic extremes. So we're seeing equity allocations surging to these levels that we've not seen since 2021, and just before the market experienced a massive amount of volatility in what year? 2022. So I said at some point in this video, 2026 could look like a repeat of 2022. Of course, it's always going to rhyme a little bit differently this time, but it could happen if we have global liquidity rolling over like it did in 2022, and we have this high degree of positioning going into the year that gets unwound. All right, so we're seeing a lot of exposure being held by investors, potentially pulling markets down if we have any sort of sniffles. With that being said, let's jump back out and zoom out for a second, because we just went through a number of very credible angles that you can look at for the market and paint a bear case for crypto and stocks. And ultimately, the general idea is that if we have a bear market in crypto in 2026, stock market's also going to be in a bear market because they're rather correlated. It really comes down to what could perform still within the stock market during a bear market. There's a number of options. We'll talk about that in a second. Or if we have a bull market, a liquidity-driven bull market in both asset classes, which one is going to outperform which? So let me draw my conclusions for you guys. We'll talk about performance of assets going into 2026. So at a very high level, 2026, if we have a bear market similar to 2022, crypto is going to perform way worse than stocks, right? You can see the drawdowns in stocks in 2022 compared to the drawdowns in Bitcoin and altcoins, and you'll know which asset class you'd rather be holding on to or rather be in cash to buy the dip on. But the really important point to note out here is that even in a 2026 bear market, some equity sectors will still offer opportunities for outperformance. So you may see the outperformance happening in a variety of sectors and assets in the equity market that's not happening at all in crypto. Because in a bear market, everything in crypto is going to be underperforming massively, with the exception of maybe a half dozen assets, which most investors will not be able to seek out and be invested in. In the equity market, there'll probably be 3 to 5 sectors of the market that are still showing some degree of performance. Not everything is going to go down in a straight line. And also you have potential for commodities to keep going, right? So overall, the stock market is the more attractive asset class in both the bullish and the bearish scenarios. If you just zoom out and you want the best odds of winning and having a good year of performance in 2026. But where crypto wins is if there's a strong positive liquidity impulse in 2026, right? We see RMPs making a meaningful impact on FedNet liquidity, right? We see a renewed global liquidity uptrend as a result of this, and China easing, so on and so forth, along with other central banks and regions of the world. This is where large cap crypto could lead on the upside. Why? Because many large cap crypto assets currently are coming off of very deep drawdowns, right? We've had that big sell-off late 2025, and now we have more room to run back towards the highs and beyond the prior highs than equities, which are already at all-time highs, right? So the big contrast here is that most large cap equities are already at or near all-time highs, where most large cap crypto assets are not, right? Actually, none of the crypto assets that are large cap are near their all-time highs at all. But the real reason where stocks could win more broadly than crypto is if we see a repeat of 2025 in performance, right? Narrow group AI outperformance, single sector outperformance, lackluster liquidity environment, lackluster Fed environment, and we see the same sort of repeat of 2025. In this case, it's going to be way easier to play defense and offense in the market in 2026 in the equity market. Just because crypto is lacking momentum currently, right? Conditions are pretty supportive for markets at the moment. They're not necessarily unsupportive. Growth is strong. Growth could continue, but crypto really lacks momentum. So if you had to decide on what the best asset class is to have the majority of your net worth in 2026, it would be assets that are investable to you in the equity market more so than they are in the crypto market. And what I mean by that is the amount of assets that you can choose to invest in the equity market on a platform like Interactive Brokers far exceeds assets that you can invest in on Coinbase or Binance in terms of potential. So the biggest thing to note here is that if you're all in on crypto as a retail investor right now without any sort of robust tools or edge at all, and I mean a very high quality set of robust tools and an edge, a very, very high quality edge, I think it's a one-way ticket for a disaster for you. And I think you do want to be diversified between both markets, and you shouldn't be a crypto-only investor. In fact, if you want to be a crypto-only investor, I don't think it makes sense for you to be an investor at all in 2026 if some of the concerns that I highlighted in this video come to light. Now, my question for you is, I have built an investing game plan for the year ahead based on these concepts that I've discussed today. But have you? Have you spent the last 6 weeks researching all the outcomes for the market from a macro and micro perspective to understand how to shape your portfolio in 2026 between both asset classes? Because for me, I'll tell you what I'm doing. I'm investing in both asset classes based off of where the performance is. For me, I'm not marrying either market. I'm going where the performance is. So if you want to join me and follow where the performance is going to go this year based off of the macroeconomic outlook and all the research I've done, I put together a masterclass that I'm going to be hosting next Saturday, January 24th. So not this upcoming Saturday, but the next one after this at 12 p.m. Eastern time. And I'm calling this one the 2026 Investor Dilemma because most people actually don't know where to invest in 2026. They're concerned around Bitcoin. They're concerned around AI valuations. They don't know whether they should be crypto focused or they should be equity focused. They don't know what sectors of the market are going to continue to perform. There's a lot of confusion as what I'm sensing from my DMs and from conversations I'm having on Twitter and conversations that I'm having with friends, family, clients who are curious about our program. They just want to know what's the market direction like in 2026. So I want to unpack all of that for you guys in this live workshop. You can sign up here with your phone. So just get your phone out, scan this QR code. I'll give you a second to do that and sign up for your free seat. There's only going to be 500 spots for this because that's what Zoom caps us at. But with that being said, I will be going over everything you'll want to understand in terms of scenarios for the year ahead. So imagine this video. We've gone over the very high level topics. Imagine zooming into each and every one of these scenarios and understanding which specific assets would perform at what point of the cycle and how to identify whether we're in a liquidity bull or bear market and what specific indicators you're going to want to understand going into 2026, because it will be a complicated year, right? If you thought 2025 was complicated, 2026, you're in for a whole new challenge. Same challenges coming from Trump, new challenges coming from AI and a rapidly changing economy, and new changes coming from an ever-evolving landscape of investors who are using technology in their investing versus just their own brains to decide what they're doing with their money. So let's talk about systematic investing, and let's do it in detail on this live workshop happening next week. I'll be showing you guys some of the newest systems we've built behind the scenes at Alpha AI to navigate the equity and crypto markets in 2026. Now, why do I have credibility to say this? Well, I've operated Bull Market Blueprint, world-class investing mastermind for the past 3 years now, going on my 3rd year running Bull Market Blueprint. And we have all 5-star reviews on Trustpilot, right? Rated 4.8. How do we get the 5? Somebody from Trustpilot, please text me and let me know. But with that being said, number of testimonials and case studies you can see on our website here of the people that we've been helping master markets over the past 3 years of outperformance in crypto and most recently equity markets. So we've been crushing the crypto equities all throughout 2023, 2024, and 2025. But now we have developed a new system for the broader equity markets and a capital allocator between each market so we can decide how to be invested between crypto and stocks at any given time of the market cycle based off of the market regime. Now, if you want to jump in and see where my strategy is as of right now and see the tools that we have developed for investors in 2026, you can apply for access right here. But if you just want to get a taste of what the year ahead could look like for the markets, I encourage you to sign up and save your free seat here for next week's investor workshop. Join me on the live. I'll do an extended Q&A after the live presentation is over, so you can jump on live and ask me any questions that you have about the markets, portfolio positioning, ideas, so on and so forth. But we've caught a lot of what happened in the crypto markets over the past couple of years with insane amounts of accuracy. We've been insanely contrarian at some points and right. Most of that evidence is on this YouTube channel, as much as I feel comfortable sharing in terms of not ruining it for the people inside of BNB who are paying good money to be there. But I encourage you to look into our track record and all of the resources that you can find about us on this YouTube channel in terms of understanding my specific philosophy for investing in the crypto and now in the equity markets, much more focused, where we have much more opportunity, right? In a year where potentially crypto is drying up and going into crypto winter. So I'll see many of you guys on this workshop next Saturday, January 24th at 12 p.m. Eastern, 9 a.m. Pacific. And I'll unpack the year ahead for you all so you can understand with confidence, where are we going in 2026, why, and how can you best capitalize on it. That being said, guys, that wraps up today's video. I'll catch you on the live and I'll see you in the next video. Cheers.